Good morning and welcome to another monthly update from Dan White and Associates. As far as the market goes, the Fed met yesterday and I guess they're declaring the war on inflation is over. They paused for about the third straight meeting and in fact they implied that they might even cut rates 2 to 3 times in 2024. Well, that was very welcome news for the markets. The markets rejoiced and we had a banner day yesterday and really have recovered from these October lows, and now we're really within spitting distance of the all-time high. We're less than 100 points from the all-time high. And while our outlook has kind of been doom and gloom for most of the year, stocks have done really well. The S&P 500 has almost regained all of its 2022 losses. It's up over 20% this year. And one well-known strategy that we have talked about at length, the 60/40 portfolio, has been making headlines this week. Most of you have probably heard of the 60/40 portfolio. It's one of the most commonly touted approaches to investing. Put 60% of your money in stocks, 40% in bonds, and set it and forget it. It's supposed to help investors balance the upside potential of stocks with the downside protection and stability of bonds. Well, the 60/40 strategy is on pace for its best year in more than 3 decades. A typical portfolio following this approach is up over 14% in 2023, and it had a return of over 12% in November alone. So based on all these outstanding results, you might think the market is finally getting on firmer ground. Well, again, not to throw water on the parade, but today I want to talk about the rally and explain why you should still be a little cautious heading into next year. The most intense market rallies often occur in bear markets, not bull markets. And when that happens, it's easy to lose sight of what's really going on in the economy. According to Michael Hartnett, a strategist at Bank of America, the biggest monthly surges in the 60/40 portfolio often precede pullbacks. Bloomberg reports that the popular approach has only returned 12% or more in a single month, 10 times since 1980, and frequently it was a sign that the market was nearing a top before a recession. For instance, the 60/40 portfolio surpassed 12% twice in 1980, right before the worst U.S. recession since World War II. It exceeded that threshold again in 2000, 2008, and 2020, and now it's once again above 12% again. That doesn't bode well. As hopeful as the market's recent surge might feel, it might be setting the stage for a big downturn. Bloomberg's data shows this pattern has played out time and time again, almost exclusively during recessions. And the reason is simple. Recessions cause investors to act irrationally. Feelings tend to take a back seat during bull markets. When almost everything is going up, you don't have to be too worried about a loss here and there. But when times are less certain, emotions run wild. Volatility leads investors to panic sell, which leads to even more volatility. This is why pretty much every recession has been preceded by a double top, a second stock market rally that nearly matches the previous high. And even though the S&P is going to end this year with a gain, the economy is not healthy. Banks aren't lending at full capacity. More companies are going bankrupt than they did last year. And the common man is facing more debt than ever before. So today's bear market rally is masking some deeper economic challenges. The best 60/40 months have always come when the market is acting irrationally. Don't expect this time to really be any different. So we may hit the all-time high in a day or two. I would not be surprised if we did, but again, none of the cracks in the wall, so to speak, have gone away. We're still the debt is a concern, higher interest rates are a concern, and commercial real estate, banking. There's still a lot of cracks out there that could blow this thing up. So. That's it for the market. Not a whole lot else going on in our office. The holidays are here. We want to remind everybody, if you have a Gmail account, love to have you go online and give us a Google review. We've gotten about 65 of them now. So we do appreciate everybody taking the time to do that. But if you haven't had the time to do that, maybe over the holidays, you could do that for us. Our holiday office hours update, we're going to be closing early on Friday the 22nd. We're going to close at noon. And then we're going to be closed Monday, Christmas Day, and Tuesday, the day after Christmas. We'll also be closed on Friday, December the 29th, and then again on Monday, New Year's Day, January 1st of 2024. But as we close 2023, I just want to have the opportunity to thank each and every one of you for your business, your friendship, all the kind words earlier in the year when I was recovering from surgery. So I want to wish everybody a very Merry Christmas and a happy and blessed New Year.